But first, one I want to show to you and prove to you is that by placing all or most of your money in the market, sure, it can have some great years and you remember those great years, but then you wind up where we are today in a situation where you feel like you're out of control with your money because of the fact that outside forces, today it's politics, is leading the way, and anything you touch inside that space, so to speak, in that market space, you're going to get hammered when certain decisions are made, or Wall Street freaks out over any decisions that are made. Coming up, we're going to look at all this craziness in the market, the fluctuations, the ups and downs, and what's going on, and what you can do to learn how to make money outside the market, and how one very famous, well-known investor has a secret investment he's been using for decades to mitigate against market loss. That's coming up. What I want to focus on today is what's been going on in the market lately. You know, it's been very shaky, the ups and downs. We have seen days where the market has gone up by 10% or down by 10% just based on moves made at the White House. Now, first off, I want to tell you on this show, this is not a political show. There will be no political rants. We're here about learning how to make money, how to save money, and how to possibly save on taxes, right? So it doesn't matter what the political spectrum is. Whoever's in office is going to make moves that is going to affect your bottom line, whether you're a Democrat or Republican, whether you're pro-tariff or anti-tariff. The issue is here, though, that any of the moves that are made from the White House or Capitol Hill wind up somehow affecting you in the bottom line. How we solve that is to make moves on our own so that we're not affected. Right. So as you see, when there's political moves made here, Wall Street gets a little concerned, a little shaky, and you can see these overcorrections both ways. And you and I are at the end of the day left holding the bag and having to deal with this kind of bipolar up and down situation. Not a lot of confidence at the time of them being in the market. But what's funny is we have such short-term memories as investors, right? It's like we just worry about what's just happened right now, but we so quickly forget that we continually go through these cycles, right? Right now we're having them, and we've had them 5 years in the past or maybe 10 years in the past. The bottom line is they always come up. Right now it's because of politics, okay? Right? One side makes a move, the other side makes a move. Once again, Wall Street gets shaky, gets concerned, and there are overcorrections, and you can wind up losing money. That is my point here today and the point of this show. It's called being truly diversified. What you need to do and what you need to learn, and what I'm going to show you, is how you need to take a portion of your money and put it in places that does not have any effect based on things like politics and outside forces. That is the key of this show. That is going to be the key of this show every single time, is learning how to see outside the box. Don't fall for the cookie cutter advice that you get on a daily basis from financial advisors or your friend who's an insurance broker, because literally they try to sell you one of two options and they make you believe those are the only two options. As a matter of fact, if you have a 401k, you truly only believe you have one option, and that is the market. Now, at your workplace, that might be true because they just give you this short menu of selections to choose from to invest in. All right. And that's the game you've got to play when you're at your employer, or if you have a 401k. But what I'm here to let you know is there are a vast array of places that you can place your money that doesn't have to follow Wall Street, or doesn't have to be shoved into some CD or some type of boring annuity that doesn't outpace inflation. So we're going to get into that here and show you exactly how that works. But first, one I want to show to you and prove to you is that by placing all or most of your money in the market, sure, it can have some great years and you remember those great years, but then you wind up where we are today in a situation where you feel like you're out of control with your money because of the fact that outside forces, today it's politics, is leading the way, and anything you touch inside that space, so to speak, in that market space, you're going to get hammered when certain decisions are made, or Wall Street freaks out over any decisions that are made. So here's the solution: being truly diversified. You have to try to find a way. There are three keys to this: is to Find a way to put a portion of your money away from any outside forces. So let's talk about those outside forces. Obviously, right now on the front page is politics. Any political move we're making right now, whether it's the Democrats, Republicans, Trump, whatever have you, is going to have effect on the market. They make a decision a week out, 2 weeks out, and all of a sudden you see the market overcorrects. Correct? We've seen that. Tariffs. We're hearing about it. The market gets hammered. Oh, we've decided not to do some tariffs or pull back on the tariffs. Market goes up, right? Just these quick decisions, all of a sudden, the market, one day, if you've got $1 million in an IRA, could be down to 900,000. You wake up the next day, it's now to 980, right? It's just a crazy, crazy place. Now, I'm not saying the market is bad. We want to make sure we understand that here, that we all understand that for me to sit here and tell you that the market is some big, bad, scary place that you shouldn't stick money is insulting to your intelligence. We know that the market has been tried and true for over 100 years, right? Everybody knows that the S&P, if you put money in the S&P and keep it there and hold it there over a long period of time, in past history, it has shown it has worked out. But you have to diversify your money. So politics aside, what else could affect your money? Well, economy goes in cycles. If we go into a recession, inflation obviously is the big word of the day. We used to talk about recession a bit. It's always a possibility, but inflation seems to be rearing its ugly head consistently. We had low interest rates for a long time. Now those interest rates have steadily increased. It's getting more expensive to buy goods, gas. Eggs have been the thing in the recent sector. We always talk about bread as an indicator. So as you realize there that the economy obviously could have an effect on the bottom line. You have outside forces such as a global pandemic. COVID hit, decimated everything, and has been a long term to bounce back. Something like that could always happen again. And as also we see foreign issues, whether it's Ukraine, the Middle East, could be North Korea. It's been quiet over there for a while, but that could pop up. Back in the 90s, we had situations like dealing with Saddam Hussein, or any of those issues are going to create havoc on the market. So what you need to do is find something that is not affected by any of those external forces, number one. Number two, you want to find something that has a competitive return. And this is where the argument goes against, well, I'm going to shove all my money under my bed or put it into a CD or some type of annuity. Look, those are snugly safe approaches. They're all great. And it's a great place, what I call safe money. You definitely want to put a portion of your money in safe money just for those emergency times, but you don't want to overload it. Too much money there, where do you get killed? You get killed by the silent killer, which is inflation. If inflation goes up 4, 5 to 6% at some point, and you're making 3% in your CD, you're getting crushed. You're actually losing money by doing the safe choice. And this is what we find, is that when you're approached by people in the financial sector, there's only one of two options, which is you should be in the market and I'm the best advisor out there and I'm better than your last guy who was better than the guy before, who was better than the guy before. And they all do the same thing. It's all cookie cutter. If you're the kind of person who likes to take a step back, zoom out, and understand the why behind smart investing decisions, I have something for you today. It's a short guide that I wrote called The Secret Smart and Wealthy Investors Use to Make Money, Even in a Bad Economy. It breaks down why so many retirees are overexposed to market volatility and how smart and wealthy investors like Warren Buffett have been hedging against stock market risk by investing in something known as life settlements. Now, on this show, we cover so many perspectives, but with this ebook, we will delve into the key metrics, show you real case studies, and also show you how you can access this type of investment for far less capital than what you may think. If you want a simple, clear read that gives you a new lens on retirement investing, all you have to do is head to lifeassetllc.com/book. Again, that is lifeassetllc.com/book, or click on the show notes and get your free copy today. Okay, now let's get back to the show. They move the money around and hope that it works out, take their fee, and will, of course, champion themselves when they make you money. And when the money loses, you start getting excuses, which is, it's only a paper loss. You got to hang in there, right? It's probably been a rough time for them for the last few weeks making up their new excuses, right? Now, again, A portion of your money, even a majority of your money, probably should be in the market depending on your age, depending on your risk tolerance. But at the end of the day, if you have it all over there, I kind of equate it like, saying that you are well diversified inside a casino because you play a little bit of blackjack, you play a little bit of craps, you play a little of that roulette, maybe some Keno, but you're still in Vegas and you're still gambling and they will take their cut. What happens then is you run into some insurance broker, maybe went to some dinner seminar of his, and he told you that essentially if you buy yourself into annuity, it will get market-like gains, which is fully untrue. And I can show you, we will break down in an upcoming episode, the dirty secrets about annuities. Okay. Not that I hate them. If you get an annuity that has an income rider on it and you realize that money is going to just try to pace with inflation and be your, extra social security blanket for yourself at the end of the day, and you're happy with that, then it is a safe place to put money because it is guaranteed where you will have a pension play down the road. But most people don't understand the annuities. They just buy them because their broker oversells what they're able to do, puts you in a long-term surrender, 10 to 15 years. And within 3-4 years, you realize the thing doesn't produce. And guess what? Because I know a lot of these guys, they are gone. They won't answer any questions because all they want you to do is just to buy the next annuity. Okay. So the idea here is a perfect blend. You need to have money both in the market, a little bit of safe money, and then delve into what's known as an alternative investment. This is where we step in and educate you. Again, the alternative investment needs to have competitive returns. A lot of people I've worked with are seeing double-digit returns. The second thing is, again, it needs to not have any outside influence, political issues, economy, foreign wars, or pandemics, things of that nature. And so where are we looking? Well, where my clients look to, and a method that I look to, is what I call true diversification. And I have an ebook that you can get on this called the True Diversification Blueprint that we're more than happy to give to you. We also have a video that you can take a look at as well. It discusses that we like to follow Warren Buffett's lead. And why do we do that? If you're of my age, you might remember the old analogy that we talk about, which is Michael Jordan. And this is where we can argue as, yes, to me, Michael Jordan is the greatest basketball player of all time. And the issue here is in the 90s, we used to watch Gatorade commercials. And if everyone remembers the slogan, it was, "Be like Mike, if I could be like Mike." Well, the Michael Jordan of investing, in my estimation, is Warren Buffett. So when you're dealing with investments, don't you want to be like Warren Buffett? Well, Warren Buffett for decades has put money in a secret investment, so to speak, where he has made double-digit returns without dealing with market risk. So while all this market stuff is going on, the ups and downs, the tariffs, the pulling back from tariffs, the political situations, Warren Buffett knows a portion of his money is going to make money regardless. It doesn't matter what the market does. This is why he is diversified, and it's a very, very smart play. So this is where we educate people on what Warren Buffett does. He puts a portion of his money in something called a life settlement. You may have never heard about this. You might have been confused by it. As I run to many people, they misunderstand how it works. What essentially Warren Buffett does is he buys out existing current life insurance contracts that are permanent, meaning these policies will pay out at some point, right? They're not going to expire. They will pay out. He is buying them from people who no longer want their insurance policies, who are in less than healthy states in life. People 75, 80, 85 years old who have an amalgamation of health concerns. Nothing like that is going to make them pass away tomorrow. Okay. We're not talking about people who have brain cancer where they're going to die, or pancreatic cancer and they've been told they have 6 months to live. Those type of people most likely would not sell their insurance policies, and their ask price would be way too high. We're talking about 80-year-olds who might have several issues in their history that leads people to believe that they're more than likely not to live for a significant period of time, being 3 years, 4 years, 5 years, 6 years, or anything of that nature. He buys out their policies for a certain amount, and then simply all he does is he's just in a waiting game, okay? He waits for them to pass away, and then he gets his return. He's been doing this for decades, and he has been making a very nice competitive return that outpaces inflation. So let's review. What he's doing is going into an alternative space, buying life insurance contracts on people who are elderly, who have health issues. Are those contracts affected by outside forces? The politics of the tariffs, Trump, anti-Trump, both sides, whatever the wheeling and dealing and going in politics that affects your money that's in your 401k, that affects your bottom line, that affects the economy. Does it affect the insurance that is on the person that he holds? It does not. It has no effect, period. End of story. The contract is the contract. He owns it. And now he's just in a waiting game. It's that simple. He's seeing decent returns, outpacing. Matter of fact, a study showed that ultra wealthy investors, much like Warren Buffett, who have been in this space, are averaging about 12% return. That's much more than they are getting if they have to deal with worrying about inflation, number one, and much, much higher than they would get in a CD or dealing in any type of insurance contract, dealing with annuities or anything of that nature. No matter what your insurance broker sells you, your indexed annuity or indexed IUL is not going to pace in a double-digit fashion. It won't even be half that, most likely. So this is why Warren Buffett plays in that space and takes that approach. And it's something that he and big banks and a lot of savvy, smart investors have been using for decades. And now we're educating you here on this show on how it works. At the very, very simple elevator speech, it's this: helping people buy insurance contracts on elderly people who do not want their policies, and then you being in a waiting game, just waiting for them to pass away. Now, that might sound ghoulish. I fully understand, but there's a lot more to this. We call it compassionate investing. Here's why. These are people who do not want their policies anymore. They have no need for them. They bought them a long time ago to protect their families, to protect their mortgages in case they died while they were working. They're no longer working, they're retired, and now they need end-of-life care, right? So where are they going to pull that money for? They don't want to reverse mortgage their house or mortgage their house. They don't want to pull money from their IRAs or pension plans because all that money will be taxable. So they're sitting on this large asset, which is their life insurance policy, that they are having to pay premiums on, which can get expensive in their elderly age. So there's a cost to it every year, and it has no need for them. Their families don't need that money. What they need is the money now, so they rather trade it in now to get the money today to pay for end-of-life care, and that's where you or a Warren Buffett comes as an investor. So that's how it works. It's very simple, and this is something that we do and help people do every single day. So if you want to learn more, you can, of course, go onto our website. And of course, as we go down this road and take you through how this works, we're going to break down exactly how we recommend people buy these types of policies and show you how the taxation works. And we're going to have a lot of experts coming up in future episodes on why they buy these policies, why they recommend these policies. We're going to have advisors, we're going to have investors, and best, of course, that everybody wants to know, we're going to talk to expert CPAs and on why they recommend this, because there's also possibilities for some decent tax breaks getting into this space.